Accounting for goodwill has been one of the most controversial and puzzling issues faced by the accounting profession. English courts dealt with the matter as early as the 13th century, and the term has been used in business since the 14th century. Over the last 100 years, we've seen the accounting for goodwill impairment evolve from immediate write-off to an amortization model to the current impairment model we have today. Now the FASB's issued a proposed ASU that will again change how we account for goodwill. I'm Casey Miles. Today I'm joined by Diane Powers. We're both senior managers in KPMG's Department of Professional Practice. So Diane, in a nutshell, what's the deal with this proposed ASU?
It's pretty simple, really. Basically, it removes Step 2 of the current goodwill impairment model. So if you recall, currently, Step 1 identifies impairment and Step 2 measures it using a fairly complicated process. This proposal says an entity would stop at Step 1 and measure the impairment charge as the difference between the carrying amount and fair value of the reporting unit.
Okay, so let me make sure I have this straight. Instead of doing that whole purchase price allocation and all that stuff in Step 2 now, I would measure the impairment of a reporting unit by the amount that the carrying amount of the reporting unit exceeded the fair value of the reporting unit.
Yeah, that's right. But just remember, your impairment charge cannot exceed the amount of goodwill recorded on the books. So, why would the FASB decide to do something like this?
Some will recall that about 2 years back, the FASB, with the help of the Private Company Council, developed an alternative allowing private companies to amortize goodwill and test it for impairment at the enterprise level. So the FASB is revisiting the accounting for goodwill broadly, and this is the first step of that process, aimed primarily at simplification.
Paul Munter is a partner in KPMG's Department of Professional Practice.
As you know, the current goodwill model is a goodwill impairment model is a two-step process, and many preparers asserted that that's a very costly undertaking, and perhaps the benefits of it aren't really warranted, because what the FASB has learned from investor outreach is that investors are far more interested in the signal of goodwill impairment, but the amount itself isn't as important as the fact that there is an impairment. So it is certainly a simplification initiative, but it remains to be seen whether this is where the FASB stops with respect to the accounting for goodwill by public companies, or whether it continues to revisit the broader question of whether goodwill should perhaps be amortized, written off immediately, or still remain subject to an impairment-only model.
So it seems that the proposed ASU is simple enough.
Yeah, it's pretty simple. Well, except, for that issue of reporting units with zero or negative carrying amounts, that situation can get a little odd.
What's the deal with these reporting units that have zero or negative carrying amounts? I mean, it seems to me that a reporting unit that had a zero or negative carrying amount would typically always pass the goodwill impairment test under Step 1 because the fair value is always going to be more than that negative carrying amount.
The fair value is thought to have some value, so call it a cent or a dollar. So in those cases, it would obviously exceed the carrying value at zero or negative.
B.J. Orzechowski is a valuation partner in KPMG's Department of Professional Practice.
But that isn't necessarily the case if you look at it using a different unit of measurement. And an example of an alternative unit of measurement is business enterprise value, also known as BEV. In some cases, you might have an equity value, fair value if you will, where the value might exceed the carrying value. But if you look at it through a different lens, such as BEV, you might find that the fair value of BEV is actually less than the carrying value.
All right, so do we have an example?
Yeah, we have an example.
Are you going to make me try and solve it?
You can try.
All right, let's hear it.
Okay, so in this example, we have a reporting unit with a carrying amount of 90.
Okay, so that carrying amount of 90, we get to that by taking the net assets of 60 plus the goodwill of 40 less the net deferred tax liabilities of $10, right?
Yeah, that's right. But the fair value of this reporting unit is only 80.
Okay, so because the fair value of 80 is less than the carrying amount of 90 of that reporting unit, under current GAAP, we'd say that the reporting unit's impaired, and then we move to step 2 in order to determine the exact measurement of the impairment, right?
Yeah, that's right. But under the proposed changes, the impairment charge is actually just $10. So that's taking the fair value of 80 less the carrying amount of 90.
Proposed ASU does require a new disclosure related to those reporting units with zero or negative carrying amounts, but overall adopting the new guidance should be pretty easy since it has to be done on a prospective basis. The FASB's already issued a draft of the proposal for comments, but they're still in redeliberations on those comments. So there could be further changes to the ASU before it's finalized. Diane, so for all this talk about goodwill impairment, how are you feeling? Do you think our lives are going to be easier?
I'm feeling pretty good. The future seems bright. I think it's safe to say that we're living during the most extraordinary time in history. The history of goodwill, that is.